It now appears increasingly likely that we're going into a recession because the consumer is clearly weakening. The pandemic-era savings have now been fully depleted, credit card debt is at an all-time high, the personal savings rates have dropped to the lowest level since the great financial crisis, and then finally we now also have a new wave of retail theft sweeping across the nation. But is this really a surprise to anyone? I mean, we've had very high inflation in recent years, with the prices of goods and services rising a lot faster than incomes for the most part. Moreover, the Fed also hiked interest rates to a multi-decade high at an unprecedented speed, and if you look back at history, you'll see that we've almost always had a recession after such a steep rise in interest rates. Therefore, it's hard to imagine how we could escape a recession. We have long overdue for one to happen anyways. But that does not mean that you should stay completely out of the market, because there are some sub-segments that are much more resilient to recessions than others, and one of them is that of real estate investment trusts, or REITs in short. They have historically performed especially well during late cycles when interest rates are cut, like today, as well as during recessions, enjoying about 2 times lower downside than the S&P 500. I'll put the chart on the screen where you'll see all of that, and I would add that the performance of REITs during recessions would have improved even further if you removed cyclical property sectors from it, like hotels, malls, and offices, which typically perform quite poorly during recessions. But it's the opposite for most other property sectors. Think about cell towers, data centers, healthcare properties, farmland, single-family homes. Really, most property sectors, e-commerce warehouses, really perform quite well even during recessions because they enjoy long-term leases. Tenants are unlikely to change their real estate footprint because of a temporary slowdown in economic activity. And at the end of the day, this is essential infrastructure that we desperately need. To give you an example, consider the case of a REIT that specializes in medical office buildings as an example. The demand for medical services doesn't drop during recessions. People still need to take care of themselves, and the demand for medical services is more a function of demographics and the aging population rather than the broader economy, and therefore a recession really wouldn't have any major impact on such a REIT. On the contrary, it could even benefit it because it will likely lead to lower interest rates, so lower interest expense for the REIT, higher cash flow, and this would also justify a higher valuation multiple. With that in mind, I'm buying a lot of recession-resistant REITs that offer high dividend yields and steady growth prospects in anticipation of a recession, and in today's video I'm going to discuss 2 of my top picks. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and before going into today's video, I want to let you know that we'll soon discontinue the 2-week free trial that we are currently offering for our REIT newsletter. So if you want to access my entire real money portfolio and my trade alerts in real time, now is your last chance to take this trial for our new newsletter. Again, you won't be charged anything in the first 14 days, so you can join, have a look. If it's not for you, you can cancel anytime. That's perfectly fine with me. Now let's get to the first company. And that is New Lake Capital Partners, ticker symbol NLCP. This is a microcap REIT that specializes in cannabis cultivation facilities. Here you might wonder how a small cannabis REIT could be considered to be recession resistant, and I wouldn't blame you, but here you need to consider the following points. Firstly, this is a net lease REIT with 14 years left on its leases on average, and the tenants are fully responsible for all property expenses, including even the maintenance of the property. Secondly, the rent is already preset for the entire duration of these 14-year-long leases, with annual rent escalations of nearly 3%. Therefore, even if we went to a recession and market rates dropped a bit, this shouldn't impact New Lake Capital Partners because it has very long leases with pre-agreed rent hikes, and therefore the rental income should keep on rising. Thirdly, today the company enjoys very high rent coverage ratios, which means that its tenants are very profitable and easily able to pay off the rent. Even if their profitability drops somewhat, there should still be enough margin of safety for them to remain current on their leases. Fourth, the company has close to no leverage, and in fact it's strongly net cash positive, which is truly unique for REIT. Fifth, cannabis is a bit similar to alcohol in that its consumption is not very cyclical, and in fact in a recession its consumption may even increase as people look for ways to cope with stress and anxiety. And then finally, it's important to consider the company focuses on limited license jurisdictions with growing demand, and therefore the supply-demand dynamics are very attractive, which provides also margin of safety. The license is tied to the property, and these properties are really essential infrastructure in this sector, and yet the demand is expected to keep growing over time, and therefore we have a situation with limited supply but growing demand, which is very attractive for real estate investor. For all these reasons, I think that the business of New Lake Capital Partners should be quite resilient to recessions. Moreover, the REIT is today priced at an 8.5% dividend yield, and the dividend is really well covered with a payout ratio in the low 80s. Remember that the REIT doesn't have to pay any property expenses, it doesn't have capex to keep the properties in good shape, so a payout ratio in the low 80s, especially also for a REIT with no leverage, is quite conservative. This dividend has been growing at a very steady pace. It's been hiked in nearly every quarter since going public, and again, given that the company has nearly 3% rent escalators, its tenants are unlikely to face significant difficulties down the line, and the REIT also keeps buying more properties, I think it's quite likely that we'll see this growth continue even if we hit a recession. Finally, I will also note here that NewLake Capital Partners is today quite a bit cheaper than its close peer Innovative Properties Trust, ticker symbol IRPR, and that's despite, in my opinion, owning better properties on average, having lower leverage, and having stronger long-term growth prospects because of its smaller size, lack of debt. And I think that the main reason for this discount is simply the listing of the company, which is inferior. Today it's trading on the OTC market, whereas Innovative Industrial Properties is on the New York Stock Exchange. In the future, this could change, which would likely lead to upside for shareholders. If you want to learn more about this opportunity, you should know that we just recently conducted an interview with the CEO of the company. This interview is available to the members of High Yield Landlord, and you can read it with the 2-week free trial that I mentioned earlier. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button? That will help me a lot to keep on growing. The second REIT I'm gonna discuss now is called Healthcare Realty, ticker symbol HR. In the introduction of this video, I mentioned medical properties because they are very recession resistant. The demand is not cyclical. If you have a health issue and you need to see a doctor, you will go see one whether we are in a recession or not. Moreover, the population is aging very rapidly, which should lead to growing demand for healthcare services over the long run. With that in mind, I would expect Healthcare Realty to do quite well in a recession. This is the leading REIT that specializes in medical office buildings, and most of its assets are in medical clusters of rapidly growing markets. Most of its properties have many years left on their leases. They also enjoy 3% rent escalations, just like NewLake Capital Partners. And the management thinks that its portfolio is today underutilized, which would allow it to lease more space and grow its occupancy rate in the coming years, leading to even higher cash flows for shareholders. In addition to this organic growth, the company is today also busy selling assets at relatively low cap rates in order to fund share buybacks at much higher yields, pocketing the spread and growing its FFO on a per share basis. So far this year, they have already raised 400 million via asset sales and JVs with private equity players like KKR, and currently they already have under contract or LOI many other asset sales, and in total they expect it to be over 1 billion. This should allow the REIT to fund more buybacks, which will grow its FFO on a per share basis, all while also deleveraging the REIT to lower its risk. The dividend yield is today at 7%. We believe that it's sustainable, and the management has asserted that expect its payout ratio, its dividend coverage, to improve in the coming quarters. Here's what they said on their most recent conference call. The combination of our operational and capital allocation momentum will drive an improved dividend payout ratio and lower leverage moving into 2025. And so I really like the story here because you're getting a dividend yield of 7%, which we believe to be sustainable. And on top of that, we expect the company to grow its FFO per share by roughly 5% annually going forward. Combine those two things together, you get roughly 12% annual total returns. And if then you get some upside on top of that, as its multiple expand when interest rates are cut, you could earn very strong returns, and this is coming from a healthcare REIT with medical properties in rapidly growing market. Again, this is a pretty defensive sector, and so the risk reward is very attractive in my opinion, especially for income-oriented investors. That is why we own Healthcare Realty in our retirement portfolio at High Yield Landlord, which aims to maximize safe income. And if you want to access all the other holdings of our portfolio, you can join our REIT newsletter for a 2-week free trial. I'll put a link to it in the description of this video. Otherwise, if you thought that this content was valuable, I'd really appreciate if you click the like button, subscribe to the channel. That will help me a lot to keep on growing. Thank you so much. Let me know also in the comment section below what REITs I should cover next. Thank you. See you on my next one. Bye-bye.